Hi, everyone. I'm Rob. I'm a sophomore at NYU.
I'm Howard. I'm also a sophomore from NYU.
And I'm Chris. I'm a sophomore at Penn.
And we're going to be pitching a short on Reliance. So essentially, Reliance is a steel services center that's recently been trying to pitch itself as a higher margin industrial distributor. They've recently been outperforming because of elevated mid-cycle margins. But our view is that uh, there's like latent margin compression because lower priced metals have not been cycled through Reliance's inventory yet. And this will cause their gross margin to compress, which will eventually result in their valuation reverting back to more in line with industry peers.
So company overview, what does Reliance do? So Reliance is the largest metal service center in North America by both revenue at around 40 billion and also volume share. And so what does a metal service center do? They purchase metal, like raw material metal from metal manufacturers, typically steel mills, and then they provide value-added services, which are typically like cutting or shaping the metal to customer specifications. And then they resell that metal back to their end market consumers, which are usually typically too small to order steel mills, as steel mills usually require like a certain size order, which like typical consumers wouldn't be able to meet. So Reliance's revenue, as you can see in the chart in the top right, is almost made up 75% of steel. I don't know if you can see the blue stuff. The blue half is carbon steel. So between carbon and stainless steel together, it makes up almost around 3/4 of the revenue, which is why their financial performance is tied to pretty dependent on metals pricing, as you can see from the pretty rough correlation graph on the bottom. And so we found that there's a lag between when gross profit margin reacts to the metal pricing environments. Like as metal prices go up, gross margin will go up with a brief lag. We'll talk about a bit later, and also vice versa. But yeah, so what is the investment setup? So management's narrative is basically that it's not a metal services center and that it's an industrial distributor company. And so the point of that is because industrial distributors have much higher margins than their metal service center peers, which allows them to be valued at a much higher multiple than their metal service center peers, which is why Reliance is trying to position itself like that. And so a huge step that Reliance actually took is that in 2023, previously Reliance was actually named Reliance Steel and Aluminum. And in 2023, they actually changed their name to just Reliance, which per earnings calls, management explained that a primary reason for that was because they wanted to make Reliance much more investable and attractive to investors, because having the word steel in the name basically associated them with as a metals company, and like tied their performance to metals, which is like sure what they're trying to position away from that. And so this entire narrative hinges on the fact that they can meet 29 to 31% sustainable margins over time, which it's kind of cut off, but it's the orange circle in the bottom right. And so because of that, because they've been able to maintain their margins in this range for the past few months, that's why they're trending upwards. As you can see in this chart, they're the orange. They're trending upwards towards their green industrial distributor peers, and they're still higher than metal service centers, but they're still, not really there. But our view is that Reliance is still fundamentally a metal company. So if you look at the products that Reliance and other metal service centers sell, it's all raw materials that they're slightly processing, cutting, and still selling raw metals back as their product to the end consumer. Whereas industrial distributors are selling industrial products that are either partly or fully finished, such as like pipes or valves, and they're selling these, which is why they're able to produce a higher margin compared to Reliance metal service centers where they're just selling raw material quantities. Additionally, they also rely a lot less on distributors rely less on slot prices because they're not selling direct commodities. And as you can see, Reliance is the orange line. That's their margin compared to industrial distributor peers, in yellow on top. And while they're still higher than metal service center peers, the bottom lines, they're still much lower than industrial.
So how could Reliance actually hide its true margin and to keep the margin higher up? I believe it is coming from the LIFO inventory valuation method. So when using LIFO, which is the major accounting valuation method that Reliance have been using, COGS derived from the cost basis that are most recently purchased materials. while it previously purchased inventories not yet to cycle through. So let's take an example. Metal A is bought in Q1 2022 for $10 and sold for $8 in Q4 2022. There's a margin loss for $2, but metal B is bought in Q3 2022 and for $8.5 and sold for $8 in Q4 2022, and the margin loss is $0.5. With LIFO inventory method, metal B's cost basis is booked first, while metal A's cost is not yet to cycle through. So the margin loss will be booked as an inventory write down baked into COGS, and the inventory cycle creates a big lag that makes the margin compression in falling price environment. And if we look at the LIFO reserve of this company, it's been decreasing throughout the falling price environment. And this also tells us when to exit the trade. So we look at the historical data, and we found that there's a typical 2 quarters lag between the steel material pricing as well as the COGS. So as the margin fall below the low end of guidance, which is 29% suggested by management, there will be a clear narrative violation, and the investor as well as the market will compress the multiple. The earliest pricing of the steel could bottom around Q4 24, which is referred to most of the North American steel plant earnings call. So with a 2-quarter lag, we recommend exiting the short when the margins trough in Q2 25. And we estimate that current true margin is around 28%. Historical mid-cycle margin is around 26, but given that the management has improving their volume leverage as well as efficiency, give them 1 to 2% of credit.
So I guess all of this raises the question of why management would go through this ordeal of trying to rebrand Reliance as this higher margin business. So basically management doesn't have to hit the gross margin target in order to be compensated just based on the way their compensation plan works. And then this isn't like a central part of our thesis, but we thought it warranted like a discussion. So management doesn't own a majority of Reliance's stock. They own around 1%, but the dollar amounts that they own are in the tens of millions. So we believe that this is like a in-between spot where they're not too concerned with Reliance's long-term reputation, but they do want to benefit from like the short-term upside of pitching Reliance as this higher margin business. Yeah, so the way we did our valuation was, as we said earlier, we give the metals Reliance's margins bottomed out at around 27%. But we do give them a bit of a boost due to their size and their higher portion of value-added servicing, which is a higher margin segment of the business. And we believe that this 28% margin will result in an EBIT of around 1306 right there. And their multiple will be around 8. Their peers trade around 7, but we think Reliance deserves a premium due to their size and their higher margin value. Yeah, so just to recap on our presentation, we believe that steel spot prices will decrease, which leads to a bottom at around Q1 or Q2 2025. And we believe that we should exit the short around this time before prices shoot back up. The main risk to our idea is that steel prices bounce back earlier than expected. But even so, we get to around 1.8 million, which is only around like 8% downside. And of course, to help mitigate this risk of dealing with commodities, we can go long on a basket of other metal services centers. Because once the price of metal bottoms out, these metal services centers will be trading at a pretty good discount, and then it'd be good to go long.
We are open to questions.
I can see how the market might be fooled by this LIFO, this LIFO versus FIFO type of accounting. But is there any evidence that that's a thing? You know, that I mean, that's true, that should be apparent in other valuation, you know, elsewhere in the market and elsewhere in time.
Yeah, so one thing we should have noted about Reliance is that they are pitching themselves as an industrial distributor on non-public roadshows. So this is something that the management team, a narrative that the management team is actively trying to push. And then we believe that because Reliance's multiple is just way too high considering like what they do, we believe that investors are buying into what management is saying.
Right, but just specifically, I mean, this LIFO thing, you sort of fit to the fact that they're overvalued, thinking maybe that's what it is, or I'm just trying to figure out if it's an endemic problem with valuation.
Yeah, I mean, I guess like the way we were looking at it was with this. So basically, like in this graph, the gray line is gross margin, or sorry, not gross margin, it's COGS, but we lagged it 2 quarters. So essentially, it should be like pushed quarters that way. And basically, what that's showing is that like as like so in reality, right, as metal prices go up from Q1 21 to like Q4 21, the COGS will go up from like Q3 21 to Q2 22. And so like because of that 2 quarter lag that we found like from looking at this, like that's why I believe that like that's why we believe that currently, like because their gross margins are still high because we haven't reached that lag yet from falling steel prices. So that's how they're able to keep the margins so high right now, which is why that's a buying story. But as as this lag is realized in the next quarters, we expect that their gross margin should fall and their costs should be going up.
I just want to add on that. So, using LIFO is not uncommon. It's very common in the metal processor like business, but like there are other like peers within the industry who are also experiencing the margin compression, basically with along with the metal price, but they are not pitching themselves as a distributor. That's why they are valued at very multiple. But Reliance doing is they try to pitch them as a distributor to get a higher.
I had 2 questions. One was, have you compared the return on invested capital of Reliance versus either the service seller peers or industrial distributor peers? And if so, what was the delta there?
I don't think we did make that comparison.
Okay. Second question is, the margins do seem substantially higher for Reliance versus the service center peers. They seem frankly a lot closer to industrial peers. Do you know why that's the case?
We do think that Reliance is the highest quality metal services center there is out there, because they have a higher portion of value added services, which is a higher margin business compared to what other metal services center.
If I can jump in, like I think I want to say it's like over 50% of their revenue comes from value-added services. Like in comparison to like other peers, metal service centers, which are much lower.
Okay. I mean, I guess maybe the question I'd have or the pushback I'd have on this is I don't their margin profile is dramatically different than their peers. Industrial distributors tend to have really nice returns on capital and pretty definable moats. It looks like their margin profile is really different. I understand that they provide similar services to the metal service centers, but I guess other than that, I mean, the business looks quite different from a margin profile. And I'm just curious. It seems like it should trade at a premium, whether that premium is 1 or 3, I don't know. But I guess maybe more specifically, what is it like? Do you have an appreciation of why this isn't as good as an industrial distributor, other than the fact that they sell different products?
They are the biggest in terms of size and volume share, so that's why we think that they are like the best distributor. But it's mostly about the higher portion of value.
Hey, how much of your returns are driven by the multiple re-rating versus the margin normalization?
The majority of it is from the change in the multiple rate.
How does that make you feel?
I think that fits in line with the story that we see, because our main thesis is that the narrative that management has set out by presenting clients with higher margin, we think that's wrong. So we think mostly about the multiple affects evaluation.
I think if you're going to make a multiple contraction argument, you need to have a very good explanation for why the business doesn't deserve the multiple. And I think when you showed the charts, there's not, you're lacking an explanation as to why the multiple is wrong. I recognize they're not industrial distributor, but everything you showed suggests it's a much higher quality business. And I think it's a big gap in what you presented.
I think our view was more that like it should be valued at a premium compared to metal service center peers, but it should not be valued at the same thing that industrial distributors are. So like if industrial distributors are like, let's say like 10 times, let's just like I'm just playing numbers out here. Like let's say industrial distributors are like 10 times and like metal service centers are 5, like they should be somewhere in the middle, not like at 10 times what like they're trying to be valued at.
Maybe time for one last question from the judges. Last question. Great. Congratulations.